Welcome. Have you noticed over the past year, prices and interest rates have risen dramatically, but you're not sure why? Interest rates have a dramatic impact on the affordability of cars, homes, and other major purchases we make with credit every year. In this video, I'm going to give you my unique perspective to help you understand why this is happening, what you can expect, and most importantly, how you can benefit from this in 2022 and beyond. Hello, I'm Matt from Shoe Capital, where I talk about all things personal finance, investing, and business. Section 1, why are rates on all borrowed money rising? I'm sad to inform you that in the United States, we truly don't live in a free capitalist society. It turns out there's a small concentration of power called the Federal Reserve that is responsible for setting the overnight interest rates between financial institutions, which indirectly drives interest rates in the US economy. Their monetary policy is to maximize employment and create price stability. The Federal Reserve publicly has had a spoken target of 2% annually for inflation. Inflation literally means your money is figuratively on fire every single day, whether you lose it or not, in terms of losing its purchasing power. This is why people invest. Inflation is a tool used by the Federal Reserve because it creates a constant incentive for spending and economic productivity. Unfortunately, since 2021, inflation has spiraled out of control and it reached highs over 9%, and it's currently hovering around 8.5% in September of 2022, well above the Federal Reserve's 2% target. In simple terms, this means if you had $100 last year, you only have $92 of purchasing power this year. In addition, the sad reality is inflation on other goods and services have been much higher. One that comes to mind immediately is gasoline, which since last year has risen over 32%. The Federal Reserve is attempting to increase interest rates in the hopes that this will slow economic activity and help bring inflation back to their 2% targets. Section 2. So what does this mean? You can expect that as inflation stays above 2%, interest rates will continue to rise as the Federal Reserve raises the overnight federal funds rate. Loans will become more expensive, meaning you'll pay higher interest to borrow. On a positive note, you may notice your savings rates and CD rates increase. We will probably continue to see the stock and bond markets have a negative reaction to rising interest rates, although anything is possible and the market can be unpredictable. The reason I believe this might be the case is businesses rely heavily on credit to borrow, as well as the consumers who buy their products heavily rely on credit to make purchases over time. You can also expect that your basic needs, including food and energy, will probably continue to increase over time until inflation is brought back into check. Section 3. What about home ownership and the 30-year mortgage? In the United States, the 30-year mortgage directly drives home ownership for the average American. Currently, the average interest rate in the United States is hovering around 6% on 30-year mortgages. The best rate I could find in my area with excellent credit, 20% down, and no points was around 6.25% per year. So what do 30-year mortgage interest rates mean for affordability? Well, on average, every 1% interest rates increase, it's going to increase your mortgage payment about 10 to 15%. So this is a dramatic driver on affordability for the average mortgage. So compared to a year ago where interest rates were just below 3% on the 30-year, and they're now over 6%, that means the average borrower can expect a 30% increase at least on their mortgage payment for a similarly priced home. The serious reality about this is the average person is not making 30% more from their job, so this is going to have a dramatic impact on the level of home that they can afford to purchase. In general, the housing market is not as efficient or liquid as the stock market, so it can be a lot slower to react, but I would definitely expect some kind of correction in either 2022 or 2023 in housing. Section 4. So how can I benefit from this situation for my next home purchase? First of all, if you're interested in a home, saving for it has become a little more incentivized because high-yield savings accounts are now starting to pay some reasonable interest. From some of the online offers such as Ally Bank, Marcus by Goldman Sachs, you can get around 2% annually on your savings. A little bit of extra incentive to start saving for your next home. While you're saving for your next home, you can anticipate home prices coming down as the market will equalize affordability with the new reality in interest rates. So if interest rates have doubled from where they were a year ago, we can expect some kind of correction in home prices, and that's already become evident in local markets that I have noticed where prices are coming down, there are less bidding wars, and it's becoming easier to compete as a buyer for your next home. It's not out of the question that we could see corrections of up to 30 or 40%, potentially even similar to some of the levels seen during the last housing crisis. In general, as interest rates increase, you should be able to negotiate better pricing on your next home. And you'll see that based on the number of bids and the number of days that homes sit on the market. In addition, if you're able to buy a home affordably under these higher interest rates at a lower price, you will probably have an opportunity in the future next time the economy stumbles and the interest rates are cut again to refinance at a lower rate. So you could have the benefit of paying a lower price for your home initially while rates are high, and then having the benefit to refinance in the future and pay less interest. Section 5, how to benefit from rising rates on savings and debt. So we've already covered the benefits you could experience on the home ownership side, but there are a few other things to consider as well in your journey. The first is higher interest rates on your savings, and there's a great option beyond the online savings accounts that we just talked about, and these are offered by the US Treasury. They are I-bonds, which are inflation-adjusted bonds backed by the US Treasury, which currently pay 9.62% annually. There are some limitations. You can only buy $10,000 in bonds per year of this type. You can buy one 10,000 bond per Social Security number, but it is guaranteed and backed by the US Treasury. So it is some of the lowest risk return that you can achieve on your cash. In addition, another area where you can get guaranteed instant returns and savings would be on any variable rate debt you might have. So a credit card, or maybe you have a personal line of credit that has a variable interest rate. Those are going to continue to increase under this situation. So by paying off that debt as one of your focus areas, you could get that guaranteed return in savings by less interest you'd have to pay. Final thoughts to pull it all together. First, don't panic over things you cannot control. Expect interest rates to increase throughout 2022 and potentially into 2023. Plan accordingly. Every 1% increase in interest rates on your 30-year mortgage is going to increase your payment by 10%. So expect, versus last year, 30% higher payments. On a $300,000 house, this means you're going to be paying about $500 more per month, all else equal. Continue looking for opportunities, such as the high yields on savings through savings accounts, I-bonds. Look for better pricing that you can negotiate on those major purchases, such as cars and homes, which will be more competitive under these conditions. And also look at paying off your high interest rate variable debt, such as credit cards and personal loans, so that you can get those guaranteed returns. Please like and subscribe, and I look forward to engaging with you directly in the comments.